Hi, everyone. Thank you for joining us today for our webinar and virtual discussion on how tech drives returns and ESG performance. My name is Eric Moxham. I'm the Chief Revenue Officer at Bracklet, and I'll be facilitating today's discussion. It is hard to believe it is already February and roughly 1 year has passed since the start of the pandemic. Clearly, there has been a big impact on many industries, with arguably commercial real estate one of the industries that has been impacted the most. Certain asset classes like data centers, industrial, and life sciences are thriving, while hospitality, office, and retail are really struggling. The focus of today's webinar is on commercial office, but the topics we'll be discussing are clearly applicable to all real estate asset classes. At Bracklet, our thesis is that the bar for owners and operators is going up, and to succeed, you will need to be nimble, hyper-efficient, and fully focused on both tenant hospitality and ESG best practices. In terms of an agenda for today's webinar, we're going to start with a candid discussion with our all-star panelists about the trends they're seeing in commercial real estate and how tech can drive both returns and ESG performance, i.e., they're not mutually exclusive. We will then answer any questions that you, the audience, may have. To kick things off, I'm now going to introduce our panelists. First, we have Adine Mir, President at Code Green Solutions. Next, Reed Snyder, Co-founder and Head of Corporate Development at HQO. And finally, Dan Winters, Head of the Americas at Grez. And now for our first question. Reed, this one is for you. Besides virus-related safety precautions like lobby health checks and upgraded air filters, how do you believe COVID has generally impacted the industry's openness to embracing technology?
Some of the areas of interest, this has really been a force function for landlords to take a step back and understand their full tech stack. What have they invested in to date? Maybe this is an opportunity while people aren't physically in buildings to be able to make investments that you've pushed off, to be able to make types of investments so that you can safely and confidently welcome people back to the office, whether that's introducing new sensors or updating to a cloud infrastructure for your Wi-Fi and for your access control systems and things like that. We've seen a big uptick of landlord customers who are using this downtime as an opportunity to accelerate their adoption of new technologies because they can take a step back and really find the importance and identify where are the gaps that I have in my overall tech stack.
Yeah, it's super helpful. And I was on a panel last week, and part of the conversation was just about what this is likely going to be. And if we look forward 5 years and then look back, that this whole pandemic will be proved to be an inflection point for the industry's really true embracing of technology and utilizing technology across all their businesses, both to drive revenue and then also to reduce cost, and net just to provide a better experience to their tenants, to their customers, more hospitality. Just on the same topic, Adine, what are you seeing?
So just, I think piggybacking off of what Reed was talking about, but maybe from my perspective, I can't help but draw a line to ESG because it's pretty much, kind of infiltrated everything. I think the key here, at least from my perspective, is transparency, right? And so when you're talking about how landlords interact with their tenants, how tenants interact with their landlords, how those tenants interact with the technology that landlords are installing, I think, from a tenant's perspective, the transparency, whatever data is being collected, whatever information can be used to better, operate the building, make them more comfortable, make them, activate the spaces in a different way. I think that's really, really key. That's a key tenet to ESG in general. I think it's really important to the millennials and other generations that are really kind of, coming into the workforce and really, taking leadership roles in the workforce at this point. So that point, I think, shouldn't be lost in this conversation, the technology conversation in general. It could be used for a lot of good, especially when you're talking about kind of giving tenants insight into things that they may not have had insight into in the past.
Okay. Dan, what about you? You sit from a slightly different perspective. but what are you seeing just in terms of the conversations you're having in the marketplace with leading owners and operators and how they're thinking about technology?
Well, so it's interesting. There's two sides of the coin, and I really like what Adine brought up, right? Transparency. And Eric, you also mentioned basically, business 101, which is maximize your inputs and minimize your waste. So ultimately, every building has its own P&L. It runs like its own business. And that's what we're trying to achieve. We want tenant retention, like Reed spoke about, and we want to make sure that we're measuring metrics that matter. So when I consider what ESG means, it's sort of a big tent and a broad thing of issues, right? So it can touch obviously energy, water, waste, greenhouse gas emission accounting, right? And people are looking for sort of, where are we today and where is this building going to be in the future? Are we trending towards obsolescence and those kinds of issues? So all that gets wrapped up into this conversation. Ultimately, we're in a moment where the property types that you spoke about that are doing great, the data centers, labs, and other things, on the one hand, that's great, but office is a wild card. And people are trying to figure out, well, what does it mean? We're seeing lots of potential to downsize or just put everybody off into their homes and work remote. So those are the issues that are on the table. What we do at GRESB is we benchmark on an annual basis. And so we're having now schisms in the data that will start to show in 2021 as people are looking at their 2020 consumption metrics, because we've had a lot of empty buildings, particularly on the office side. So that's happening on the one hand, and people are going to try to figure out, well, how does that compare to prior years? But on the other side, there's also moments where folks are flushing their buildings and they're running them 24/7 to try to create a different kind of environment. And then when that happens, it's sort of energy costs be damned, right? Because we want to have that moment for our tenants. So I don't know, it's an interesting year, but people really have their eyes razor focused on these issues without a doubt.
Yeah, it's certainly going to be interesting. I mean, clearly, the big question is when everybody's going to start returning to the office. But then when people start to return to the office, what does that mean? And I think you've certainly seen plenty of comments from both public and private high-profile companies about pursuing a hybrid model where employees are going to have the flexibility to continue to work from home. Obviously different for different roles, but then also to go to the office. So then the real key question is, how do you motivate people to come to the office? And I know one of you guys talked about this before, but so, the bar is really going up. And if there is pressure, from just the demand perspective, and, I think we can all agree that density is going to go down, and density was a big driver of commercial office pre-pandemic. So even with density going down, the question is that going to offset, the reduced demand for office space in a new hybrid model? And so the key is how can you use technology to, entice people to come back, to have them be comfortable coming back to the office from a safety perspective, excited to come back to the office because, there's going to be opportunities for, enhanced productivity and relationship building. And then, so if you're an operator, so how do you do all those things? How do you provide better tenant amenities and services? And at the same time, because of the pressures on rents and the need to be really aggressive in retaining tenants and attracting new tenants in a much tighter marketplace than pre-pandemic, it's how can you cut cost? And so that's where technology can help on all those different things. And at the same time, as we talked about, and this is what the next question is about, and clearly Dean and Dan are seeing this, is ESG. I mean, I probably would have thought that ESG would have taken a back seat with the pandemic, just if nothing else because of the focus on cost. But it's actually become the embodiment of the pandemic, and it's really about building health, obviously tenant safety, obviously reducing carbon footprint of buildings, and being a good operator and a good global citizen. And so it's taken on all these different things, and diversity is obviously as well. And so I guess with all that, so I'll throw this out to Dean. So where are we actually in ESG? Obviously, it's super topical. It's picked up steam post-COVID, but where are we in terms of the industry's adoption of operating practices? Are we kind of still in the box checking phase, which, from my perspective, where we were pre-pandemic, but are you starting to see operators, really, having ESG impact how they invest in their properties and how they manage their properties?
How much time do you have to talk about this, Eric? That's
we got a few minutes.
So I think, so from my perspective, it's been really exciting to see that the industry's made a lot of progress, even pre-COVID, right? So I think, I'll give you a short answer at the end of my long answer on this question, but I think we have seen, an industry that's notoriously slow to evolve, and that's not, to offend anybody that's listening to this, but it's notoriously slow to evolve. That's the reality in general. But we've seen it start to pick up the pace over the last couple of years. And the way that I think about that is three kind of pressures, right? Legislative pressures, investor pressures, and tenants. And there's probably other pressures, but if I can break those down for the audience relatively briefly, I think that hopefully will be helpful. So the legislative pressures in the last 10 to 15 years, have been significant, but rather incremental in terms of the way that they've been implemented. It's really based on energy legislation, reducing kilowatt hours. And so, the first tranche of those laws was about 10 to 15 years ago. It was really about energy benchmarking, studying buildings and seeing where the financial opportunities were to get a really quick payback, like a 2-year payback, which is generally, what real estate companies had historically looked at as, okay, I'm going to greenlight that project. Anything longer than that is a much more difficult sell. And so, what we saw during that period of time was really kind of eyes opening to what the opportunities could be. Even if you're just measuring your consumption, people were starting to see, okay, there's opportunity here. So that was really kind of a first step. Then, New York, cities like New York passed legislation at the same time that required energy studies to be done. So they saw that there was benefits that they could start to fold into their capital plans, when they were thinking about big pieces of equipment or tenant spaces turning over and things like that. We're currently really in the second round of that legislative evolution, and that's where much more aggressive legislation has been passed. I'll use New York City as a proxy. The Climate Mobilization Act, Local Law 97, really, essentially is a carbon tax on buildings, and regardless of a lot of nuance, say what you will on the law. I think what we've seen is that these aggressive targets, just for those who don't know, targeting the biggest emitters in 2025, so the kind of worst 20% of buildings by carbon emissions, with aggressive fines, and then kind of doubling down on that for 2030 for the rest of the building population. So we have a lot of clients in Manhattan that operate very large buildings, and they're looking at $1 million plus annual fines if they don't do something about their carbon emissions. And so, not surprisingly, that law has completely changed the conversation. It's changed the payback conversation. It's changed the math. It's changed the desire, to either figure out how to pass things down to the tenants in a different way, or to actually see a little bit further down the line and see that there's an advantage to taking, kind of proactive action on things like this. On the investor financial side, I think GRESB has played a really important role in bringing that pressure to the United States. It's existed in Europe for quite a while. I think very much as a way for investors to look at real estate funds and sort of, level set in terms of ESG progress, and then really look at that as a proxy for just good, efficient operation and good and better returns. And so that's really started to hit the road in the U.S. in the last, 5 or so years, just in terms of the amount of portfolios, funds, institutionals, REITs that are saying it's not just about checking the box anymore, which is very much, I think, where GRESB was 10 years ago, which is you need these policies, you need to be reporting, you need to be kind of getting into this habit, and then hopefully you'll see the opportunity. And now GRESB has really shifted to more of a performance-based approach. And so that's where you're starting to see that conversation get much more sophisticated, much more in the granular kind of data. And then on the tenant side, I think, the point's been made already. I'm sure it'll be made again. tenants and landlords generally have a conversation when the leasing process is happening, and then after that, for the next 10 or 15 years, historically, hot calls, cold calls, like that's pretty much where it ended. I would say that what we've seen with some of the pressures that Reed was talking about with this desire to have more amenities in the space. This was already happening pre-COVID. Even though the WELL building standard was gaining traction pre-COVID. So obviously the world has changed a lot in a year. And what hasn't changed, I think, is that the tenants and the workforce that are pushing these operating companies to make CSR commitments, ESG commitments, they're the ones that are pushing this conversation. They're the ones that are, want to see everything from a LEED plaque to, how efficient you are with your space to what your air quality is. So completely change the conversation in a way that I think is really good for the general buying marketplace, but is a very, very complicated position for landlords to be in when they're balancing all of these issues. So to summarize what I wanted to kind of get across here, I think we're pretty early in the transition from checking boxes to actually seeing that information turned into insight to really be able to use it to affect significant change. But that pace of that adoption, or that moving from policies to performance is picking up significantly right now.
Okay. Yeah, and I would just editorialize that if we are, and it looks like the market is moving to shorter leases, then those conversations are going to be much more frequent, and operators are going to need to be positioned to have those and to really show what they're doing, and a track record of consistent performance. So Dan, you've obviously GRESB was just involved in a very exciting transaction where you guys were acquired and capitalized for growth with Summit Partners. Clearly, I think that was a really exciting development in the industry. And then, we have a new administration, the Biden administration. We just rejoined the Paris Accord. So I think both your organization and then just here in the United States, I mean, the opportunity, the environment for change is huge, and really, there's a lot to be done here. So what are you seeing? I mean, obviously you guys sit from a seat where you're evaluating a bunch of different operators, obviously trying to get more and more people to come into the fold and report. But what are you generally seeing out there with all of your parties you're working with?
Well, first off, the Deans did such a great job. I nearly dropped the mic and just stepped off stage, and was going to call it good. That was great. Thank you. A couple things. So over the arc of the last 5 years, we're seeing the concept of targets show up. It's one of those check the box exercises in GRESB, because GRESB is 50 odd questions about best practices. One of those questions is, does this fund or firm have targets when it comes to energy efficiencies or greenhouse gas emission reductions, whatever that may be? So that behavior started to instill, and now we're watching that shift. It's now moving away from, we'll try to get 10% reduction by 2025 based upon 2018, right? That's like, do that, no problem. Now it's moving to science-based targets. And we're seeing a real big push for that. So I can imagine that people will be judged against science-based targets that are supposed to be on a slope of the line. Are you above? Are you below? How are you doing? And look, that can be very, very difficult because you're captive to what exists on the ground right now. So you can do OpEx things, and that's usually the low-hanging fruit. And that's the idea behind benchmarking, right? If you've got a portfolio of 100 buildings, you figure out by going through this mandated exercise kind of, right, which buildings are doing great and which buildings are down here not doing so well. Do these folks need an OpEx coaching? Do they need some CapEx love? What do they need? Either way, you've now bifurcated your portfolio so you have a better understanding of what's going great and what's not. So that's helpful once you put it all in context to say, how are we doing against science-based targets? And that will be in vogue over the next, call it 2 cycles. The next thing is physical and climate risk, big push now for that. So we've gotten away from, is this real? Is it happening? All that stuff. I think, there's money to be made in Miami, so let's not redline anything, but let's make certain that we're thinking about these issues from a resiliency standpoint. How is this property, and more importantly, from our perspective, how is this portfolio positioned to deal with systemic shocks and risks and things? And believe me, this pandemic that we're experiencing, this is, a trial run for climate change. So there was not a question in GRESB about, are you pandemic ready? I don't know if we're even going to put one in there next year, because it's really all about, how are you managing this portfolio well and delivering better risk-adjusted returns to your investors? That's really where it plays out. Obviously buildings make up a portfolio. So I'd like to now turn back to you and perhaps Reed to see, other things that are happening on the building level. But from a portfolio standpoint, investors have their eye on this ball. They want to know that you've got some good operators and the portfolio is positioned well for the future.
Yeah, and Dan, you talked about this, but I think one of the key things with any technology is, if you have a portfolio of office buildings, every building's different, right? Different design, different size, different geographic location, slightly different utilization in terms of occupancy, density of the occupancy. But the question is, does your technology take into account all that? So you can actually, when you're analyzing, your portfolio and looking at what assets need more attention than others, do you have a technology that actually takes into account the uniqueness of each particular building, but allows you to have a standard for evaluating your whole portfolio and where you spend your time? Reed, I'll turn it over to you. I mean, you guys are a little more generalist and working with a bunch of different technologies really across all aspects of real estate. But I know also you've been getting a lot more inquiries about just ESG. What can you tell us about that?
Yeah, it's kind of the cool part about my job, that I think that I get a lot of input from the market on trends they're seeing, investments that landlords are looking to make, technologies they're looking to deploy, a lot of stuff that we talked about at the top of this call. And we at HQO, we've had we call them the pillars of tenant experience. We've had 6 of them for a long time. We've had sustainability as one of those pillars. But I think maybe it was Adine that said it, or maybe it was you at the top, Eric, that said, it's kind of a checkbox. Largely that was the sentiment from the market towards all those sustainability initiatives, whether it was, corporate social responsibility or energy efficiency and things like that. From our purview for, our first couple of years in market, it was kind of that checkbox mentality. And we have noticed a material shift in the last 6 to 12 months. I think a lot of it's the pressures that Adine and Dan have spoken about, whether from a regulatory perspective or otherwise. But we have seen a true shift in sentiment from our landlord customers and an urgency to be able to address these challenges. And that could manifest itself in a lot of different ways that we're hearing from customers. It could be, hey, we're just looking for ways to surface insights about our energy efficiency. So could we work with someone like a Bracklet through your platform? That might be an example. But at the same time, we were talking with one of the largest landlords in Europe recently as last week. And the feedback we got from them, or the challenge rather, I should say, was, what is your carbon footprint at HQO, and how do you impact our carbon footprint as a landlord if we were to deploy HQO across our portfolio? And that's that's frankly a tough one to answer. And that's something that we're actively really thinking about. So this is because of all the trends that the group has talked about, we've really seen a shift in terms of the urgency for this type of initiative.
Okay, super helpful. So we were talking about obviously where we are, from a box checking perspective to being really a key requirement for, how tenants evaluate, a particular building. Among them a bunch of different attributes, and then also investors, building owners, some are REITs, some are private equity firms that have limited partners. Obviously the REITs have public shareholders, and then some are obviously pensions, endowments, and insurance companies that have direct real estate investing operations in addition to being LPs and public shareholders. But I think the real question is, if you kind of roll this forward a couple of years and ESG continues to the momentum continues to build, when do you guys think it's going to start to be punitive, in the sense that if you are an operator and are not reporting, not demonstrating a track record of consistent improvement, at the same time you're driving top quartile returns, when do you think it's going to start impacting, that particular owner operator's ability to, access capital, from top institutional investors? And then the same thing where, it's going to be, if you're not doing those things, it's going to reduce the demand for your space. So, Dean, I'll kick it over to you to get your comments on that.
That's a great question. I mean, we work with clients across the spectrum, right? Mom and pops with 6-10 building portfolios to, hundreds and hundreds of assets. I think we're there. If the whole industry isn't there yet, there's certainly a subset of the industry that's already thinking about it in this way and has been for some time. And I think, it's not an abstract concept to those players. And by extension, I think it's going to be pretty clear. There was a comment in the chat that I couldn't help reading, that when I think it's related to when you go out to fundraise, it used to be, check this box if you have a policy around ESG. And that is not an acceptable, that's not a question that doesn't go much deeper, in our experience, in our conversations with our clients. We have clients that are thinking about this. It's like a pillar of their investment thesis, right? They're saying this is not an issue of putting a trophy, a plaque on our trophy asset, right? This is way past that at this point. This is really about risk mitigation, primarily, making sure that, from the due diligence phase all the way through disposition, we are, doing our duty to our investors and to all those that have a stake in the organization. I think the jury is already out on whether or not this is the smart thing to do for organizations. What we see kind of time and time again is that real estate organizations tend to be siloed, and that we are often the kind of fulcrum point that brings them together, right? So acquisitions, development, never talks to operations. They never, they just hand them the keys to the new asset and hope that they operate it well. I think those days are numbered, if not completely gone, because at the end of the day, it's really not doing your due diligence in the investment that you're looking to make into your fiduciaries if you just ignore the fact that this is, a really critical thing for you to do. And then, at the end of the day, where it used to be looked at as a marketing, approach, which it still can be if you're actually doing something that kind of proves out what you're saying that you're doing, you're going to perform better than the other similar portfolio that's not thinking about these things. That's pretty much a fact at this point. There's been a lot of research and data around it. So I think at the end of the day, ESG is really, I think about it as connecting dots that aren't necessarily being connected within the organization, using that data that's coming out right in an insightful way as quickly as you can. And making sure that you use all of that, and allow it to inform your investment decisions. Because, why would you not do that? It's sort of good business to be able to take additional information when you have the decision point and make sure that you have an approach. And it doesn't mean that that all high performing in portfolios are associated with an ESG program. It just means that the vast majority of them, are going to be, it's going to be kind of a consistent thing that is a best practice. So, I would leave it there. It's just a smarter way to do what you need to do, and to make sure that you are ahead of those investor requests, because they're going to come if they haven't already.
Yeah. Well, I think it's safe to say there's definitely the pressure is going up for operators to really embrace ESG operating practices. Clearly, pre-COVID, Larry Fink at BlackRock laid down a proclamation just in terms of how they're going to start aggressively looking at ESG performance as a investment criteria really across all asset classes, including real estate. And then I'm sure you guys all saw they backed that up by putting out a very detailed report of all the different areas of ESG that they're going to be asking that existing portfolio companies, prospective portfolio companies will report out on and what they expect. And then the other thing they came out with just at the beginning of this year was their 2021 real asset outlook. And I think there was like 5 key tenets in that. And one of the ones that I thought was the most interesting was this is a time for active asset management. And so active asset management, obviously, embracing technology, to provide a better tenant experience, reduce cost, but then also as it relates to ESG. So with that, I'll kick it over to Dan. I mean, Dan, where are you seeing, or where do you think this ultimately plays out? Because, like anything else, it's when it starts to be, when opportunities start to be taken away, when it starts to reduce demand for your office space, when, you aren't able to get as many meetings, when you're on your roadshow trying to raise money, that's when all this becomes extremely real. So where do you think we are?
Well, so I think about measure what matters. And what have we been measuring to get to this point? Money. How did you do? What's my IRR? What's my NPV? And now we've heard from everybody here, carbon, right? So is there a price on carbon? No, but there's sort of backdoor prices on carbon, whether it's what's happening in New York, the various benchmarking laws, to the tone and tenor that's coming out of the EU that Reed brought up with his recent meeting. So for everybody on this call, don't lose sight of that. That is coming. And when exactly, unclear. What I observed with the building ratings, whether it's Energy Star or LEED or BREEAM or whatnot, these are all signals, right? There's a lot of power in an economic signal. When we were all little kids, we had the Good Housekeeping seal of approval. If you think about what LEED is, it's a series of attributes of a building that go beyond mahogany and marble and beautiful lobbies and all of those things to say, well, what's happening here? They did more things than a code building. They're doing things on the operational side. What is that? And so those signals start to drive behaviors. Carbon will start to drive people in a particular direction. So that's where we're heading, but change is slow. It will take a while to get there. And so and then we've heard the word performance. So what exactly is ESG performance? It's kind of difficult to tell. So we're in the process at GRESB of a dialogue with the global industry to say, what does performance really mean? And sure, we can figure out energy, water, waste. Those things on the E are easier to count. The S is squishy, it's tricky, right? So, but people are looking at those attributes and those issues on a building level, right? Eric, you brought up the well standard before, I think Adeem did. So that is a thing, but there's also, gender and diversity and those types of things that hopefully lead to better decision-making that happens over time in organizations. All of that stuff is fair game. It's being navigated for the next probably half decade, and it's an exciting time, without a doubt.
Okay, thanks, Dan. So Reed, I wanted to ask you this question, but I guess spin it a little differently. So we've obviously heard from Adine and Dan about the ESG part, but if you kind of redefine the question as more just about technology, how do you think, both from, once again, a tenant perspective in terms of tenants wanting to re-up their lease or lease space in a new building, how do you think, that operators and their property teams, the owner and the property teams' embracement of technology is going to impact, tenant demand? And then same thing on the investor side. I mean, to the extent that you are an operator and you're not looking at technology as a way you can provide a better tenant experience, you can reduce cost, automate a bunch of things that otherwise were manual, and just all else be, more nimble. How do you think that's going to impact, investor, demand as well?
Yeah, on the first point in terms of adoption or the value is, I think we've seen it's been a big driver for our business is if you look at the historical model, real estate owner gives the tenant a black box. You can do with that black box what you want. You just have to pay us once a month for its use. That was kind of the core part of it. And that is now dated. And that was the major paradigm shift that has led to prop tech exploding, that has led to this resurgency or core focus on ESG. Like landlords now need to provide value in more substantial ways and in more consistent ways to engage with their tenants and provide a place that people want to work. And I think, we didn't really touch on that too much in terms of the COVID discussion, but that's been another accelerant in terms of like, how do you actually incentivize people to come back to the office when all they're seeing in the press is things about work from home and things like this. And we can talk a lot about, inefficiencies or debate different, productivity and things like that based off reports of people working from home versus in office. But at the core, that's something that landlords need to meet head on. We're trying to help them do that. How do we maybe change the way we evaluate and invest in space? How do we make everything contactless so you can come in a safe and secure way as you come into the building? There's all these different things that tie to it. And then to like the investment point, I was going to say this specifically about ESG, but it also just pertains broadly because we've anecdotal evidence of this even in early innings from a technology standpoint. But this isn't just like a feel-good story. This isn't like we care about the world and we care about making a better place and thus we're going to invest in this. Like, this is fundamentally important to the business and the way that the business moves. Like, it's less so for some of the big REITs who have incredibly long hold cycles, but private equity firms that need to transact in the marketplace and sell these assets. We've seen material evidence already that, tech being a technology-enabled building or asset increases the sale price. I think we are probably at the point, and I would defer to Dan and Adine on this, but like we are probably at the point that when you are transacting for one of these buildings, which costs, many hundreds of millions or billions of dollars at the top of the market, there's going to be a material impact on the price of that building or asset based off of it being energy efficient, based off of having certain, regulatory credentials or certificates and things like that. Like, that is going to have an impact on the price because the next person who is deploying capital in that asset, doing redevelopment work, owning that for their 10-year cycle, 30-year cycle, whatever it is, they're not going to want to be stuck with footing the bill for all of this initiatives. Like, it's going to be a big impact on those transactions and the liquidity in the marketplace, I think.
Yeah, definitely. And I guess just to go back to Dean and to Dan real quick about that. I think one of you guys mentioned climate assessment, and we've certainly heard from our operators just in terms of evaluating different markets. And once again, it's, we talked about risk mitigation, but, I guess, Dean, do you want to talk about that? Just, I think we have a mutual customer that is super concerned just about, exposure from a climate perspective on, their assets in different geographical locations, and understanding, if they want to potentially reduce their exposure in a particular market and potentially increase their exposure in another market. Do you want to talk about just that a little bit?
Sure. I'm sure Dan can talk to it as fluently, if not more than I. But it's more than just, for our clients, especially the more sophisticated clients that are, thinking about these things all the time. The idea of investing in an area, let's say, that's flood prone, has a lot of risk associated with it. And so that's all kind of fallen under this umbrella. And so the idea of having building a resilient portfolio is, I think, just starting to get explored. But those market leaders are already out there. They're already, looking at what's out there. And there's some good tech tools that allow them to do that. I don't think they, go as far as they will in the next couple of years. But that is really a critically important realization. I think that people, human beings just have seen all of these climate catastrophes in front of their face. The last couple of years have been by far the highest, insurable claims in human history. And so, when people are seeing, California on fire and other places kind of flooded at historic levels, they are connecting those dots to the value of their investment, and they're making plans now and making, divestment plans and investment plans based on where that's going to go. So that's not, and I think to Reed's point, that is not a feel-good story. That is business. You know what I mean? That is maximizing your returns for the people that you need to maximize them for. And it's the right thing to do in general. Like, maybe certain areas weren't meant to have certain types of built environment on them because they're constantly flooding. So, as a species, we need to think a little bit more along the lines of, what we can do to mitigate these risks, but also, what we can do to avoid them altogether. That's just going to play out in the returns at the end of the day anyway.
Yeah, and I think it's important that yeah, particular market is not, even if it's more prone to natural disasters or impacts of climate change, not necessarily to say that that market's going to go away and people are just going to exit in mass. It's just to say, I think, to Reed's point, that if you're not proactive in looking at the associated risk and making investments in the property to mitigate any potential impacts, then if you do try to sell that asset, you are going to be penalized significantly by the next buyer, because they're going to have to step up and make those investments. Dan, what's your perspective on this topic?
Well, anytime you go into an acquisition, you're underwriting to a discount rate. And then, you're going to operate this thing. And if there's risks out there, you have this thing called insurance, which is awesome, right? You write a check and somebody else takes the risk. But those contracts are yearly. And believe me, there's conversations out there with sophisticated portfolio managers that says, well, what happens when the music stops? And do we get stuck? And did we underwrite this at the proper the proper number? Because if we can't sell it for that on the reversion, we're in trouble, right? We're not going to meet those return requirements. So those things are happening. There's still opportunities to make money in places, but it's at what risk? And so people are coming in with a razor focus more and more on that. And just to bring this all back to technology, right? We're in a big data environment. So getting back to the idea of measure what matters, I was reinforcing the idea of carbon. I was reinforcing the idea of location and physical and transitional risk, and transitional basically gets at the carbon thing. And so elevating those metrics, tracking those things is a technology conversation at the end of the day. So, it's a great time to be in tech. We need more of this data, and being able to put those metrics out there to people, hit them where their needs are, the things that matter to them, is going to drive better returns for the people that can do a good job at this.
Cool. So I guess the last question, and then we'll kick it over and look at answering questions from the audience. But I'll throw this out to you, Reed. So clearly with prop tech emergence over the last several years, there is now in real estate, as has been going on in a bunch of industries for arguably a longer period of time, but there is now a ton of data being collected in a variety of different areas of real estate operations. Where do you see, generally speaking, how effectively is the industry using that data, and where do you think the markets needs to go to, for owners and operators to truly get the full value of technology and all these different?
Yeah, I think we're still early innings. It is top of mind for, everyone we speak with, depending on how one defines data or what their incentives may be, but it comes up in every single conversation we have with the market. It's a big focus of ours, and it's not there yet in terms of adoption, interpretation, usability, actions, so on and so forth. So I think that's probably for three reasons. I think the first one is, the quality of the data inputs. A lot of the industry is still stuck in, siloed spreadsheets, or maybe they don't have cloud infrastructure in place in a building. And so thus, you're left a little bit handcuffed in terms of actually pulling data off, and you need to go back retroactively in somewhat of an analog way. There's challenges in terms of the inputs. The other one is interoperability. When we work with a lot of these large customers, some of them have made major investments into kind of a proprietary internal database where they try to connect all these dots with the disparate systems that they have put in place. But as you're acquiring, what we talked about today, as you're bringing in more technology and creating more data, those systems need to be interoperable. You need to be able to connect the dots, at least layer that data so you can actually take action from there, versus have all of these, it's not very useful to invest in 30 technologies that are going to drive some sort of data for you and then have them live in silos. And you have different personas, different use cases. That's inefficient as an overall business. And then the third part, I think that's pertinent is it's just time. We get asked, constantly, what's the ROI on this? Or, how can we, turn this into actionable data? And as I said before, it's early innings. Like we need more rent cycles. We've obviously gone through a truly unique 9 to 12 month period here. In terms of a lot of the adoption of new technology that's going to create this incredibly rich and many data sets. we're still too early to be able to effectively measure the value there. And that's something that we and many others are trying to charge towards and make more efficient. But I think those are the three big challenges right now.
Okay. Dean, you guys are working with a lot of large operators and, serving as their trusted advisor on all things ESG and sustainability. Clearly, a big part of it is, collecting, utility bill information and a bunch of other information, and then submitting it to, whether it be to Energy Star, GRES, LEED, a lot of different things going on there. But what's just in terms of data, what are the challenges? Is that data, are you seeing that data being used to really drive behaviors, drive decision-making, drive investments? What can you tell us about those different things?
So I started my career out as my ESG career out as an energy modeler. And so two kind of fundamental things that I learned early days, like first couple days that I was working in that job is one, you can't manage what you don't measure. That's, hopefully everybody understands that. And garbage in, garbage out. So garbage in, garbage out, meaning, if you have crap data, for lack of a better way of putting it, and you put it into whatever you're putting it into, you're not going to get the output that accurately reflects what you're trying to do. So I think, it's really important for anybody that's thinking about this from any level of sophistication to understand that, if you're budgeting for, ESG for the first time, or if you've done this for a long time, even basic energy, water, waste data, and there's nothing basic about waste data, but even basic data at that level is prone to gaps, errors, misinterpretation. So there's a ton of really good, SaaS tools out there that kind of act as a clearinghouse, aggregate information, give you really nice looking reports. You can't just trust it without really getting to the details. And that's what we work with a lot of very large clients that use those platforms, but we kind of hold their hand through really understanding where you're getting accurate insight back and where, this just doesn't make sense. There's a lot of cleaning up that has to be done. And that's where we are as an industry right now. We're not yet at a place where it's set it and forget it. It's very much something that needs to be actively managed. And so I think that's really important. That didn't matter so much 5 years ago. It matters now because these reports are getting rolled up. They're getting measured against performance. They're getting published in 10Ks. They're going in sustainability reports that are available on websites. So, it's the responsibility of whoever's in charge of this, this area for whatever real estate organization you're talking to, or any organization for that matter, to really understand the limitations of data availability, data, complete data versus not. So at the end of the day, I think it's great. Like, we've never had so much information. We've been collecting this type of information for many, many years as a company. But, it takes a long time before you can actually take that and turn it into something that's meaningful. And that's, I think, that's big data in general. That's where we're at. But I think real estate's a little bit behind the curve, but catching up very quickly.
Okay, thank you. Dan, clearly a big focus of yours is obviously data integrity for the data that you're currently collecting from owners and operators, but then also increasing the granularity of that data on, kind of across the different areas. And clearly, I think there's a lot of opportunity for improvement on the, clearly most of it's been done on the E side. So on the S and G side, as I think you previously talked about. But you just want to talk real quickly about just data and your focus at GRES?
Well, I agree with the garbage in, garbage out, right? The data is a mess. You look underneath the hood and it can be quite tricky. You're making estimates, there's holes, right? And so you're trying to get a complete picture. Last year, GRES made the asset level data mandatory. So all years prior, you could just give one big number that says, here's the GHG emissions, here's the energy, consumption data for this portfolio. And people are like, well, wait, where did that come from? And so that by default, if you've got 100 property portfolio, you've got now 100 rows, you've got all these columns and you need to fill them in. Rarely can a company do that. And even when they do it, it's like, how do we make that more accurate, right? That's where, the Code Greens of the world and a host of others can come into play and really help you make that data. So it becomes people's homework to try to get it better and a more complete data set, 2021, 2022, 2023. So I would just say this, technology is really enabling asset management and superior asset management, being able to put your eyes on this data, get it better, right? And make more powerful decisions. And when I consider ESG over the arc of my career, it's really put more emphasis and weight back on the asset management because, come on, let's face it, this is a 50 to 75 year asset class. Once a building is built, it needs to live longer than all of us will on the planet. So let's manage it well, right? And let's not be a transaction deal driven thing. Let's do a good job. Technology enables that. And here we are. It's an exciting time to look forward.
Okay, we're running out of time. So Dean, I'm going to ask you this question, and it's from the audience, and Dan just alluded to it. But obviously buildings do have a very long life, and so us at Brackley, we've historically mostly been involved with the existing buildings and helping optimize and upgrade those buildings. But can you just talk about how you guys are getting more involved on the development side, or how ESG needs to get really implemented from the onset, starting with the design of the building to the construction of the building, and obviously ongoing through the operation throughout the life of the building?
Sure. Yeah. So we historically had really been focused on existing buildings. I think part of the trends that we've talked about have led developers to knock on our door, and that wasn't a very frequent occurrence until recent years. And so that's really interesting in and of itself to see that happening. I mean, I think at the end of the day, what we try to impart on our clients is that, if you get it right at the beginning, it's obviously much easier as you progress through the whole cycle of the project. And, I think fundamentally there is an approach that is, not married to whatever acronym is out there in the industry at the moment, but it's really about, just operating real estate in a smarter way, right? So in a data-driven way, in a way that's tech-enabled, in a way that, reduces inefficiencies. And so at the end of the day, we're seeing kind of an increased demand on the developer side, and there's a lot of talk in the industry, really good talk about embodied carbon and sort of the impact that the construction side of the industry has on the larger global footprint. So it's really moving in a good direction. That's very much kind of way past time for it to move in. So I have a lot of hope there, but we still have, there's a lot of challenges in solving that problem, right? Developers still need to make their returns as quickly as they can, and so. It's really about collaborating at the project's, planning stage. And once you do that, it doesn't necessarily have to be that much more expensive. It just has to be, thoughtful and happen, sort of as part of the plan.
Yeah, and I would just add that I think one of the lasting legacies of COVID is these things are, when it comes to building health, defined in a bunch of different ways. That's now being taken into account in the design of the building, probably in a much greater way than it was even for, a LEED Platinum building pre-pandemic. And then the other thing I would say is just the importance of establishing a baseline for really, performance for all aspects of a building's operation from the onset is extremely important. Okay, well, with that, we are out of time. Want to thank everybody for participating, including our all-star panelists. And once again, we will be sending out a link for today's webinar to all the participants. So everybody have a great day, have a great year, and look forward to connecting again soon. Thank you very much.
Thanks, everybody.